detractors have said that you know, the Australian market does have unique circumstances. You know, we've got negative gearing, for example, to encourage investment. The supply of land in capital cities is fairly limited by geographical factors. As you've said yourself, strong immigration, and that those factors, you know, sort of maybe undermine some of the arguments you've made. What would you say to those people? What's your argument against that?
The biggest factor to me for Australia is your immigration. Now, here's the problem. If we see a global bubble, I can tell you from studying history, in the United States, we had the biggest immigration of anybody in the late 1800s, early 1900s. You know that immigration dropped to zero in the Great Depression? To zero. It didn't just go down 20. It ended. The people don't want immigrants when there's no jobs, and the immigrants don't want to take the risk and expense of immigrating when it's not a good economy. So what I've learned is in a downturn, immigration, if you're depending on immigration and foreign buyers, that can just disappear overnight, and that's the problem. That's what'll hit you, and that's why I say it's a wild card. China is what's different. I don't think Indonesians are going to keep coming in, other people, but rich Chinese, if that bubble keeps unraveling, they may say, we need to get out of here. We're rich, and our government is going to come after our wealth, and they're going to restrict us more. That's why I say that's a wild card. Any other country, I'd say, oh, strong immigration, well, don't expect it to last. It won't last forever in a downturn, but it may last a little longer here. So
Australia is a little bit harder to predict just because of that strong Chinese influence.
Now, the other thing I would say, though, and I was debating Mark Boris on this last time I was here with the Secure the Future conference, he was saying, look, yeah, I understand why stocks go down, demographics. Real estate is very expensive, and it may not go much higher, but he just doesn't see how it could possibly go down. So that's where I look at history and say, no, sorry. Bubbles don't correct. I've never seen anything bubble up and then just go sideways. If I'd seen it, I'd say that's possible. Now, so if Australia is going to have that happen, it'd be the first time in history. Okay. So I wouldn't want. Oh, so I guess my main point is, because of how expensive, I don't see much upside in real estate from here, even if somebody like Mark Boris is more. And if I'm right, it could be very substantial downside, especially if you're leveraging with mortgage and debt to buy real estate. So I just say, gosh, just back off here. See if somebody like me is right for the next year. If we don't see some major things go wrong in the world in the next year, I got cycles that point down so strongly in 2014 more than any year in this decade. If we don't see something crack this year, then I'm going to have to question some of my cycles and analysis and say, or just say, hey, governments are just offsetting any downturns. I think the governments have now stretched this bubble for 5 years, and they've stretched it where it's just going to burst. And Japan has proven this. Japan has never had a rally that lasted more than 4.5, 5 years. And in fact, even in the United States, even including the boom, we only saw one boom in my lifetime since the early 50s that lasted more than 5 years without a 20, 40, 50% correction. So I think this is the year things go. And if we get towards the end of this year and nothing really happens in the world, and China doesn't blow, or Europe doesn't go into another crisis, the United States real estate doesn't back off, and I am predicting it is going to back off. It's mostly speculation. It's not real buyers. Then I'd say, you know, maybe governments can keep this going a little while. And if the governments keep it going, then yeah, it's not going to burst.
It's the worst case scenario for Australia if all...
Here, if Sydney were to go and back to early 2000 prices, which is where most bubbles started, it'd be like 55, 60%. I'm saying 30 to 50% here. That's the range I'm looking at, and 3 to 6 years, probably more like 6. And that in real estate, that's a lot. Yeah, especially if you're leveraged and mortgaged, and it means you're going to be underwater, even if you put 20% down.
So do you think that investors, you know, in property in Australia need to rethink the way they approach property? I mean, it's, you know, I think there's common wisdom in Australia that property is a fairly safe investment. It's bricks and mortar. You can see it, you can visit it, and it's probably going to increase in value.
What's unique about real estate, and why people do need to think different, is that real estate lasts forever. Bricks and mortar, like you said. That's actually a liability in a way, because when a larger generation is dying, and what are dyers? They're sellers. They either pass it to their kids, which means they don't have to buy a house, they'd like to sell, or they sell it, put it on the market. And certainly dead people don't buy houses after they die. So when I have a new indicator that says I don't just look at the peak buyers at 41 in the US or 42 in Australia, I subtract the people who are going to die, like at age 82, I think it is in Australia, 79 in the US, 84 in Japan. When you do that, the net demand for houses The reason I did this was Japan should have bounced in the late 90s with at least a little bit the next year. It didn't bounce. And I thought, it took me a couple of years to get it. I said, oh, the old people are offsetting these younger people's demand by selling pressure. That's why it's not going down anymore. But so these indicators say even in Australia, net demand is going to slow. It's not going to go it's not going to go negative like Japan has, and U.S. will about 10 or 15 years from now. But it's going to slow. That means slowing price pressure. So on that alone, I think over time, real estate's not going to appreciate like it did. To me, it's like going back to monopoly. Why did you buy real estate when you kid a monopoly? You didn't buy it because it's going to go up in value. You buy it because when people land on it, they pay you rent. So you buy it to live in, fix up. You buy it. I mean, to me, I wouldn't buy a vacation home unless I'm going to be in 6 months. Why would you buy a vacation home if you're going to use it 2, 3, 4 weeks a year? People buy it because they think it's going to go up and you can't lose. That's the wrong way to think about real estate. I'm not going to buy something now unless if I'm not living in it full time, unless I can rent it out for positive cash flow. That's the way you should think. If you can rent it, and if anybody can buy a condo downtown Sydney or Melbourne and rent it out for positive cash flow, I want to see it.
Thank you so much for that, Harry.